Hello everyone, let's talk about inventories today. There are different types of inventories. So finished good can be inventory, or raw material can also be inventory, semi-finished goods and work in progress, as well as supplies and stores. They're all inventories. And manufacturers, they have particularly large number of inventories and different types of inventories compared to merchandisers, because merchandisers just buy inventories and sell inventories. They do not have any production process. So the task is to separate ending inventory from cost of goods sold. So you need to use inventory equation where you have beginning inventories and purchases on the left hand side of the equation and ending inventory and Cogs on the right hand side. And so you can subtract Cogs and get the ending inventory as here. And of course, the balance sheet will include merchandise inventory together with other types of current assets. And the income statement will have Cogs. So you first determine net sales, then subtract cost of goods sold, and you can get gross profit. So the task is to find the value of Cogs and to find the value of ending inventory. Ending inventory goes to the balance sheet and the cost of goods sold go to the income statement. There are several methods of finding the Cogs and ending inventory, and some of them will overestimate, some of them will underestimate them. And of course, since you will have underestimated or overestimated Cogs, you will have profit margin overestimated and underestimated in particular period. But if you look across several periods, then all the methods will give you same value of Cogs and same value of inventory. So the difference is only if you look at particular year. Next, just a moment. It would be easy, of course, to find Cogs and ending inventory if you could trace every inventory bit and piece. So you know what item you purchased, you know how it went through the production process, and then you know whether it's belonging to the ending inventory or it's belonging to goods sold. Then everything would be easy if you could trace particular inventory item. But in reality, you have thousands of inventory items and thousands of units in each type of the inventory. So you need to have some method to scientifically split Cogs and ending inventory. One method is called specific identification method. That's the easy one where you know each particular inventory item. But all other methods, Fifo, Lifo, or weighted average, they are only estimates. Inventories, of course, are always valued at cost. For example, if you purchase some inventory at $600 and then you produce final good and sell this final good at $1,000, then your entry would be, first entry would be sales. You earn the revenue credit sales 1,000 and debit cash 1,000, but then every time you sell the good, you need to look what happened to inventory. And in this case, inventory is decreased and Cogs, since you sold the good, will increase. Cogs is expense. But importantly, here you will put the value of inventory at cost. The cost in our case was 600. Please do not put here 1,000. And also it is very important to put Cogs and inventory, because if you don't put these two journal entries, then it would look like that you got sales, got the revenue without incurring any costs and without doing anything, like gift of God. Of course, it's not correct. You need to look at the costs that were incurred while you earned the revenue and got the sales. So the general issues related to the inventories. Thousands of inventory items in each production process, and sometimes it's impossible to separately identify them. There is no market for inventories, for unfinished goods, for example, or for supplies that you just purchased. So therefore, you do not have market price. You have only the cost. There will be various discounts, allowances, and transportation issues and returns. So all a shrinkage as well, inventory loss. So it will all affect the cost of inventory. Then it may be possible that you purchase inventory in October at one price, but then in November it has totally different price. So it is possible that there is inflation and deflation, and the costs of inventory increase or decrease. There may be particular sequence in which inventories enter in the production process. In other production processes, it may not be the case. In general, just remember that in many cases, it's not possible to track individual inventory items. Sometimes possible, but mostly not. So several methods. First method is first in, first out. So you sell those inventories that were purchased first. In contrast, there is Lifo, last in, first out. So you will first sell those inventory items that were purchased last. In other words, just recently. You purchase these inventory items just recently and you sell them first. Whereas with Fifo, you are selling first those old inventory items that were purchased, say, at the beginning of the year. Specific identification method is when you know what you purchased and what particularly you are selling. So you purchased diamond and then you are selling that diamond. So you are tracing this particular inventory item. I'm talking here for simplicity about merchandising, where you are just buying and selling, not producing, not putting inventory into the production process. And then there is weighted average method, applicable to those items that have low cost, that are all identical, and that purchased in bulk in large numbers, pencils, hammers, buttons, and so on. Of course, it would be impossible to track individual hammer or individual pencil. So let's look. So here with Fifo, the yellow boxes is your beginning inventory, and blue boxes are your later inventories. So you put them in the pool, and then when time comes to determine ending inventories and cost of goods sold, you can see that you are first selling those yellow boxes that were purchased first. And it may happen that you still need to sell some of the later inventories, but not all of them. And whatever is left of the later inventories will go into the ending inventory. With Lifo, it's the opposite. So again, you put beginning inventories and later inventories, later purchases in the pool, and then you firstly sell the most recent items that you purchased, these blue boxes, and maybe some early inventories. But ultimately, the ending inventory will be composed of these old inventories, yellow boxes. If it is the weighted average method, you again put them in the pool, but before you put them in the pool, you find the average price of the inventory item. And then you will just decide that 3 will stay in the ending inventory and 7 will be sold, and you multiply each of these boxes by the price that you found here, weighted average price. And same for the cost of goods sold. So you are selling 7 boxes, multiply each box by the weighted average price that you determine here. Specific method, you can see here that you identified particular item here, then you can identify it in the pool, and later on you can identify it either in ending inventory or in Cogs. So this red or pink box. And the standard method is essentially no method at all. So you purchased how many here? You purchased 6 boxes. You had 4 boxes in the beginning inventory, put them together, and then find the total price. Total price divided by each box, and then here you will have the total price, which will be same as the beginning price, and divide by the number of boxes, and you find the cost of each box. So it doesn't matter. It doesn't matter in what sequence the boxes are coming. It doesn't matter what particular box you have. You don't need to find the weighted average price. It's just the total cost here is same as total cost here. Okay. Of course, there are advantages and disadvantages of each method. So with FIFO, the big advantage is that the oldest inventory items are sold first, and so the risk of obsolescence is minimal. Nothing is obsolete. Also, the earliest goods purchased are the first ones removed from the inventory account. So that way you can ensure that the historical cost is approximately same as fair value. The disadvantage is that there is no matching, and all the historical costs, the costs of these old inventories that you purchased first, are matched against current revenues. And so there is no matching and the values are distorted. With LIFO, it is based on the assumption that the old inventories are cheaper than the most recent inventories. In other words, there is inflation, and this is, of course, a reasonable assumption. We are shifting high-cost inventory into the cost of goods sold. So therefore, profit would be reduced substantially. And therefore, if profit is reduced substantially, then the profit tax on income, is also reduced substantially, so it is smaller. So using Lifo method is a way to avoid or to reduce income taxes. Disadvantages. The problem is that if you only sell the recent inventory items, then the old inventory items will continue to stay in your inventory, and eventually they will become obsolete, very old, and then essentially worthless. With LIFO, the cost of most recently acquired inventory will be higher than the cost of earlier purchases, so the ending inventory will be valued at the earlier cost. So in other words, your ending inventories will be underestimated and your expenses, Cogs, would be overestimated. Remember that there is inflation and the earliest inventories are cheaper than the later inventories. So specific identification method, the big advantage is it's the most accurate. On the other hand, it is very time consuming and sometimes impossible to find the relevant inventory item unless it is expensive and it makes sense to spend money, spend time and find that item. But with new technologies, once you can attach the barcode or specific identification number, then pretty much every item can be identified. So these days it's becoming possible to use specific identification method. And let's look at the example. So suppose you purchase 5,200 items in 3 batches. At $4, earliest one at $4, then at $5 per piece, and then at $6 per piece. So sold inventory 3,000, unsold inventory 2,200. So if you're using first in, first out method, so you are selling 3,000. The revenue at $7 each. So your revenue would be 21,000. That revenue would be used to find the profit. Then, regarding the cost of goods sold, you start selling with it's first in, first out, you start selling with the first batch. So you sell all 2,000 pieces from the first batch, but still 1,000 missing. So therefore you need to sell another 1,000 from the second batch at $5. The first batch at $4. So you find the cost of goods sold is $13,000. Then you can find the cost of goods unsold. It's the whole third batch, 1,700 items at $6, and part of batch 2, 500 items at $5. So you will get 12,700. Okay, and then you can find the revenue. You can find the profit. So you have revenue 21,000 and you subtract the cost of goods sold from the revenue and you get the profit 8,000. Now let's look at LIFO. With LIFO, Again, the revenue is same, 3,000 sold items at $7, 21,000. So you will start selling the most recent batches. Batch 3, all of it 1,700. Is it? Yes, 1,700. The whole third batch is $6, and still the shortfall is 1,300 because we sold 3,000 items. So that's why you need to sell something from batch to 1,300 items at $5. So you get cost of goods sold, and you can immediately find the profit, revenue minus cost of goods sold. You see profit here is smaller, 4,300, whereas with FIFO it was 8,000. And then you can look at the first batch that still stays in your inventory and part of the second batch. So it will give you 9,000. And importantly, this old batch, the batch of old inventories, will continue staying in your inventory balance until they become worthless. So then the weighted average method. So you multiply first batch 2,000 items at $4 will give you 8,000. Then multiply for second batch and third batch. So add it together and you will get $25,700. The purchases, the value of purchases. How many items you purchased? 2,000, 1,500, 1,700. So 5,200 items. So you find the cost of each inventory item, 4.9. And then simply, so they tell you that they sold 3,000 items multiplied by this 4.9 cost per item, and that would be the cost of goods sold, 14,826. And same for inventory unsold, still staying in the balance, 2,200. Ending inventory times 4.9, that will be cost of inventory unsold. Total is approximately same, so nothing is missing. Revenue, again 3,000 sold at $7, 21,000, and subtract Cogs. So you see the profit will be somewhere between Lifo method and Fifo method. Then look further. Just a moment. Just a moment. There are some technical issues here. Okay. Of course, in reality, there are several there is a chain of purchases and sales. It's not like you purchase only once and sell only once. You may purchase 1,000 times and sell 900 times. So for that, you need to prepare each. You need to look at each transaction and prepare the inventory card. So let's start with perpetual inventory system. With perpetual inventory system, every time you purchase and sell the inventory, you update inventory account. Whereas with periodic system, you do not do that. Inventory account will not be involved at all with periodic inventory system. The inventories will only be counted at the end of the accounting period. So let's start with perpetual. So for perpetual, you need to prepare the inventory card. For periodic, you don't need to do that. So here is the sequence of events. Opening balance, then sale, then purchase, then sale, sale, purchase, sale, sale, and so on. So you need to first put the opening balance. So you had 4 items with cost of $12, total cost $48. We look at FIFO first. So then you sold 2 items at $12 cost. Now you are left with 2 items at $12 cost. So 4 minus 2 equal 2. Then you purchase 6 items at different cost, 12.5. So you account them separately. So these 2 items at $12 stay separately, and new 6 items at $12.5 stay separately. Now you decide to sell 3 items. So it is FIFO method, first in, first out. If you decide to sell inventory items, you need to sell first those that you purchased first, which are those items at $12 cost. So you sold them and you no longer have them. You can see here nothing that includes $12. And you also, since you need to sell 3 items and you sold 2 at $12, you still need to sell 1 item from this batch at $12.5. So now you will be left 6 minus 1, 5 at $12.5. And then you sell again 3 items, and now you're left with 2 items at $12.5. Then you purchase some other items at $13. Again, you account separately. And again, you need to sell 4 items, and you will sell those older items at $12.5 first, and 2 other one from the recent batch. And so of the recent batch, you will now have 6 items at $13, and so on. So you can see that those old items at $12, they disappear, and in the end you do not have them. So you need to double check, of course. So beginning balance 48 plus purchases 246.5 should be equal to 267.5 plus 27. So left hand side will be 294.5 and right hand side 294.5, all correct. Now let's look at Lifo. With Lifo, you start with 4 items at $12 cost, then you sell 2 of them, now you have 2 items at $12 cost, now you purchase 6 items at 12.5. Now you account for them separately, so you have 2 batches. Now you need to sell 3 items. Which items will you sell? Since it is last in, first out, you are selling those items first that you purchased last, which means this batch at $12.5. You sell 3 of them and 3 left. And this old batch at $12 is still staying in your inventory balance. And then again you need to sell 3 other items. And again you sell only those that were recently purchased at $12.5. And so again you are left with old inventory items. And you continue like that, and you can see that in the end, here, in the end, you still have those inventories that you purchased in the very beginning. By that time, they of course obsolete, most likely. And again, double check. 246.5 plus 48 should be equal to 270.5 plus 24. Now the weighted average method. So, with weighted average method, every time you purchase new inventory, you need to recalculate the price of the cost of the inventory. But if you sell them, you don't need to do that. So you start with 4 items at $12 cost. You sold 2 items at $12, of course. You left with 2 items at $12. Now you're purchasing 6 items at different cost, 12.5. What will be the new cost? The new cost will be 12.38. How do you get it? Look here. Now you have 8 items. 2 divided by 8 times 12 plus 6 divided by 8 times 12.5. It will give you 12.38. In other words, 2 divided by 8 is the weight of the old batch of inventories, and 6 divided by 8 is the weight of the new batch of inventories. And you multiply each weight by the cost. 2 divided by 8 weight by this cost, and 6 divided by 8 by this cost, and you will get 12.38. And now once you have this new cost, you multiply it by 8 items, you get the new total cost. And if it's necessary to sell 3 items, then you just sell them, but you do not change the cost. It's still 12.38. Now you're left with 5, and then you need to sell another 3. You're left with 2, but the cost is still the same. But now you're purchasing new batch of 8 items at $13, and now you need to update the price. So now you will have total 10 items. So how you find this price, 12.88? It would be 2 divided by 10 times 12.38 plus 8 divided by 10 times 13, and you will get 12.88. And in the end, again, double check. Purchases plus beginning balance in inventory must be equal to Cogs plus ending inventories. And the value of Cogs and ending inventories, these two values, will be between the values of Fifo and Lifo. this one between Fifo and Lifo Cogs, and this one between Fifo and Lifo Cogs. Then, what about periodic system? With periodic system, you do not prepare inventory card. So you just look. So you have beginning inventory, 500 units at $20, and then you purchased another inventory and another inventory at 24 and at 26. So how much you purchased? 2,000. The total cost, just add this column, 47,700. And then they tell you that of these 2,000, 1,400 were sold during the month. So find Cogs and ending inventory using 3 methods. So let's look. So ending inventory in units is for 500. Beginning inventory is 500 units. Then you purchased twice 800 and 700, and you purchased 1,500 units. So what is available for sale? 2,000, and of these 2,000, only 1,400 units have been sold, meaning that ending inventory per equation is 600 units. So with FIFO, the cost of goods sold. So you are selling first in, first out. You are selling first the oldest inventory, and the oldest inventory is 500 units at $20. So this oldest one. So multiply 10,000. Still not enough. Maybe let's start the other way. So ending inventory would be 600 units times the price of the last inventory. So it would be 15,600. Then you can subtract this 15,600 from cost of goods available for sale, find the cost of goods sold. Then you are selling the first batch, 10,000, still not enough to get 31,800. So that's why you need to sell from second batch and a bit from the last batch. And then you can find the cost of goods sold. With LIFO, it is the opposite. So the ending inventory. So you will sell from the last batch and also from the second last batch. And you will get cost of goods sold. Then you subtract it from 47,400 and you will find the ending inventory. And ending inventory will include mostly the whole earliest batch, 500 units at $20, and small part of the second batch. With the weighted average method, so you will first need to divide 47,400 by 2,000. These are the values that we got here, the total value of purchases and the total number of units purchased. So you first look at them, divide one by the other, and you will get the weighted average cost per unit. And then we know that we sold 1,400 units, just multiply it by that weighted average cost. And we know how much left in the ending inventory, 600 units, you multiply it by the same cost. You get the value of ending inventory. Or alternatively, you can subtract the ending inventory from the cost of goods available for sale from the beginning and the purchases. And that way you subtract and you will get cost of goods sold. So that's the first part of the inventory lecture. Wait, we'll talk more